Money and finance are central to a well-functioning economy. In this session, we will provide evidence that greater financial development leads to better economic outcomes for society. We will then argue that it's not always smooth sailing. Sometimes there can be disruptions within the financial system. This can occur when investors lose faith in financial institutions, or when financial innovations are too rapid and go unchecked by markets or regulators. In the second part of this session, we will introduce the idea of a financial crisis and discuss how these events can be costly for society. A well-functioning economy depends on money and the payment system. The financial system, which involves financial markets and a broad array of bank and non-bank financial institutions, channels funds from savers to borrowers. This promotes investment. Our belief is that greater financial development means more accurate market prices, a more efficient allocation of resources, and better risk sharing. You put all of that together, and we should see faster economic growth and better outcomes for society. We can test this idea using recent data from the World Bank. We can look across the globe and check whether countries with larger financial systems have better economic outcomes. To measure financial development, we can take the total amount of credit extended to the private sector. We have to scale credit by GDP so that our observations across countries are comparable. We then focus on GDP per capita as a measure of economic development. The scatter plot seems to confirm our intuition. We can see that countries with larger financial systems tend to have higher incomes per citizen. That's great news, and it suggests that we want to have more and more financial development, more and more banks, more financial markets, and possibly fewer restrictions on these institutions. Right? If you're a policymaker, then you should prioritize the financial sector above many other things. But surely there is a limiting principle here. Well, it's hard to say financial without saying financial crisis. Throughout history, we have seen episodes like this. A Depression-era bank in the 1930s with customers queuing up, hoping to withdraw their life savings. Northern Rock, a bank in England where I grew up, experienced a similar run on its deposits in the fall of 2007. This was an early warning sign that a financial crisis was on its way. Whether it's the Great Depression or Great Recession, we seem to hear the same narrative. In a first step, excesses within the financial system cause a panic. Savings are withdrawn from financial institutions, and then these institutions are forced to liquidate investments. Eventually, financial markets, such as the stock market, crash. Then, in a second step, this financial crisis causes a terrible burden on the economy. Households lose their savings, and they can no longer access credit. Businesses fail. All of this translates into a deep and long-lasting recession. Banks were central to the original version of this story. Since 1793, panics have occurred in the United States in the following years: 1797, 1811, 1813, 1816, and so on, 1873, 1884, 1890, 1893. The true name for a system with this record is the panic system. The Panic of 1907 was the first worldwide financial crisis of the 20th century. These banking panics peaked during the Great Depression of the 1930s. Between 1930 and 1933, about 2,000 banks failed per year. This was probably the worst global financial crisis in modern history. It led to the creation of our current system of government deposit insurance provided by the Federal Deposit Insurance Corporation, or FDIC. 100 years later, financial crises still involve panicky investors. Let's start with securitization. It is one of the great financial innovations of the 20th century. It allows financial engineers to take pools of risky loans and create new asset-backed securities, or ABS. Some of these ABS are rated AAA. So we have transformed risk into safety. However, the process itself is complex and opaque, so it can be hard for many investors to understand. Beginning in 2007, some of the riskiest mortgage-backed securities, you may have heard of subprime mortgages before, they started to default. Investors didn't think that was possible and they panicked. The panic spread to all securitization markets, including student loans and credit card securitizations that had absolutely nothing to do with mortgages. There was a near total collapse in credit. Money market funds. They have been central to financial panics in the 21st century. They are a type of mutual fund that makes super safe investments in short-term bond markets. Large institutional investors park cash at these funds to earn some returns, small returns, but better than nothing. Here's the fun part. These funds structure their liabilities to resemble bank deposits. They appear riskless and can be redeemed on demand. But savings in money market funds are not insured by the government and may be subject to losses. In 2008, when losses did arrive at one very famous fund, you probably don't know it, but that fund was called the Reserve Primary Fund. This was totally unexpected. Investors panicked, and the entire money fund industry experienced mass withdrawals and was brought to the brink of collapse. Problems can stem from the money and payment system too. Hyperinflation in Weimar Germany in the 1920s, Hungary in 1946, Zimbabwe in 2008, Venezuela in 2018. These are extreme examples. In each case, governments issued too much paper money. The paper money was eventually deemed worthless. The outcomes for the economy and society as a whole were truly dreadful. Digital currencies break government control over the supply of paper money. However, since the emergence of Bitcoin in 2008, they have looked more like a speculative bubble than a reliable means of payment. One point of view is that so long as price risks are dispersed among retail investors, then it probably doesn't matter if the value of digital currencies rise or fall. It is a problem for the investors, but not a threat to the financial system and the broader economy. Stablecoins are not the same as Bitcoin. Stablecoins are a special type of digital currency that peg their value to a regular currency. Tether is the most popular stablecoin. As of 2021, Tether has issued more than $60 billion worth of digital tokens, and those digital tokens are redeemable for $1 apiece. These stablecoins can be used to pay for things, and they have value because they can be exchanged for dollars. You might not know this, but Tether actually invests the funds it raises by selling these digital tokens. Where? Well, from what we can gather, it invests the dollars it collects in securities such as commercial paper. As of 2021, Tether had about $30 billion worth of commercial paper investments, making it essentially one of the biggest money market funds in the world. What's going to happen if investors lose faith in Tether and redeem their digital tokens en masse? Well, if some investors panic and worry they might not be able to get $1 per token, then they might be willing to accept 90 cents or something less. This could lead to a run on Tether, and the value of the digital currency could fall immediately. A panic of this sort could disrupt the entire stablecoin market. Worse yet, and this is why it matters, this disruption could spill over to the commercial paper market. This could affect how governments and businesses finance their working capital. It sounds like some digital currencies might be more problematic than others. When the financial system fails, time and time again we have seen the government step in and provide support. This action is usually called a government bailout. In the United States, the various government agencies spent more than $600 billion of taxpayer money during and after the 2008 financial crisis. That is a large sum, but the US is also a very big economy. It can afford to spend that much money, provided the intervention succeeds, of course. Thankfully, it more or less worked out back in 2008. Other governments cannot support bailouts of that magnitude. This chart shows the largest bank bailouts in recent history. We scale the size of the bailout by GDP to give us a sense of how costly it was relative to national income. In 1997, Indonesia spent more than half of its national income bailing out banks. Bailouts of that magnitude can lead to a sudden collapse of government finances. All right, where does this leave us? There is a trade-off. We want to promote an efficient, competitive financial sector. Innovations in money and finance move our economy forward. But we need to balance this against financial sector stability and the risk of crashes. To guard against crashes, we need to set limits. First, which institutions should be regulated? Should regulators leave private equity and fintech firms alone? This is an open question. Second, what should regulated financial institutions be allowed to do? Should Tether have the same disclosure requirements as banks? Should banks be allowed to have hedge fund subsidiaries? Should we allow those hedge fund subsidiaries to invest in Bitcoin? Finally, what sorts of government interventions are appropriate during financial crises? Our intuition is that it's sometimes appropriate to bail out failing institutions, but how should limits be set? These are important public policy questions.